Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman and Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, KILROY Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, XL Realty Advisors, First American Title Insurance Company of New York, FirstService Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, HELMSLEY-SPEAR, James D. KUHN Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the MOINIAN Group.
Hello, my name is Michael Stoller. You know, we're in a strange time. We're in April of 2009. The stock market, one day it's up, you know, at the beginning of the year it was 9,000, then went down to 6,500, and today we're at about 8,100. And, you know, people say maybe the world's getting better. But, you know, I don't have my crystal ball. My crystal apples are over there. And I really don't know what's going on. So what I try to do today is I'm assembling a group of business leaders, many of them who are involved in real estate, also people who are not involved in real estate, to provide their insight on where they see the market, the economy, and what's going on. My guest today includes Steve Rabinowitz, the partner in charge of the real estate practice for New York at Greenberg Traurig. Martin Luskin, the partner in charge for real estate globally for the law firm of Blank Rome. Coming in from Pennsylvania originally, Simon Ziff, the president of Ackman Ziff Realty Group. And last but not least, the executive chairman of New York's newest bank, Herald National Bank, Dan Healy. So since you're the new kid in town, and since, not really the new kid, but since you're the person who started a de novo bank in November, in the midst of all this surus and crisis, how do you see the world today? I mean, how is it to be a new bank in town?
A new bank in town is the perfect time to be here.
Why? Why is it a good time?
Because credit is dried up because of the economy, the recession that we're undergoing. And we have opportunities to lend money in the New York City environment that others are not. We also have a balance sheet it's uncomplicated and no toxic assets and well capitalized, and so we have a great opportunity. And furthermore, we're also hiring people, which is very, very unusual in this particular area.
You know, relating to that, earlier before the show, you know, Marty was talking about one of his clients who has a loan coming due and they have difficulties on renewing. And Marty was saying, you know, maybe the banks are gouging. What were you trying to bring out about that?
I didn't use the word gouging.
I said it. Okay.
I know you said it. What I was contemplating is a little bit more cooperation by lenders to not subsidize but help out developers or owners that would otherwise struggle without getting what they might consider exorbitant terms for a short extension of the loan.
You know, I don't want to be biased. You know, I'm involved with real estate and I'm involved in the banking business. You know, if somebody doesn't deserve a loan, or maybe the world has changed, or maybe somebody bought the property a couple years ago, or maybe Simon financed it, or it was a transaction, why should the bank be out there? They have difficulties. They have bad loans. They have difficult times. Okay, they don't have a clean balance sheet. Why should that be?
Mike, if the world worked on you determining who deserved things,
I'm not making a determination.
Really
but wait a second. I'm also saying why. You know, who's the right person?
In all seriousness, the examples I was talking about were healthy loans that, but for this drying up of liquidity, the property would have been easily financed in other times. So it's still leveraged property, there's cash flow, there's debt service coverage ratio is fine, but it's coming time to the end of the loan. They need to get another loan. The existing lender doesn't want to refinance, and the developer or the owner is saying, give me a little time. Why does the lender have to double the interest rate?
Well, because the lenders, in a lot of cases, have cost of funds, have to go out and borrow money to lend money or use money that otherwise would be reserves. There's a cost to them of doing it. And I don't think we can generalize in every case to say the lenders are being unreasonable or the borrowers are deserving. I think we've all seen it go the other way, where the borrower might not be deserving and the lender is being cooperative. I've seen cases across the board. I'm not sure that you can say the lenders are being unreasonable. I've seen lenders that are being pretty cooperative.
It's not uncomplicated, Marty. I mean, if the loan is that good, he could shop it someplace else. And you can't do it. So
well, I think you would be able to say that a couple of years ago, that you can go to different sources.
The marketplace dictates the terms. And the market is vastly different than when the time that original loan was made.
The question is more when there are gray areas. For example, there's an extension option, and the test has a debt service coverage, and certain conditions are utilized for that debt service coverage test, and it's not clear whether those conditions are met or not. That's where I think maybe you're suggesting that the lenders could be more lenient. But I agree that when the loan comes due, the lenders are going to charge whatever the market rate is.
But you know, I'm going to pose two questions. One is, I was saying prior to the show that today in the world, probably the strongest banks are the Canadian banks. They've really proven well. They've underwritten correctly. They're doing well. And you know, I gave you the example that CIBC, they are in business. They will lend money to people, but they said, look, it has to be recourse with a personal guarantee. We want to get paid our freight. We want to charge a 2% origination fee. We want a 2% exit fee. We want a short-term loan, and we want an 8%. Is it gouging? It's the reality of they're one of the few lenders out there, and they're taking the risk-reward.
There's only 5 banks in Canada that make a difference. We all know who they are, right? And those banks did not leverage their balance sheets like the U.S. banks did. And when you look at their balance sheets and look at what they lend in the residential mortgages. You don't find a lot of risky assets like commercial loans, secondary position, mezzanine loans, things of that nature. It's a totally different marketplace, and that not many of them lend in the United States.
Now, Simon, how much did you arrange as an intermediary over the last 5 years in lending of commercial mortgages?
5 years, I know, it was a little over $20 billion.
20 billion. So how much of that 20 billion that you provided do you think is not going to be able to be refinanced? I didn't say good, bad. I said
Thank you. Not good, bad. Won't be able to be refinanced because there's a liquidity problem in the system. I would say that roughly half of that will probably be some type of an extension with the existing lenders, for sure. Maybe half to 2/3.
So my question is, it relates
of the stuff that's coming due, let's say over the next 24 months.
These are commercial properties?
Commercial and multifamily.
So what happens? I mean, both of you have law practices, and we were saying before, you know, maybe certain parts of your practice aren't that busy, but certain of your practice, part of your practice is going to be better because Steve, you're going to have to take care of some of these.
Absolutely, both from in some cases from the lender side, in some cases from the borrower side. It is so specific to what market you're in, what sector you're in. You know, there might be a better chance to working out a hotel than an office building, depending on the market. Although I would doubt it in this hospitality market. And it depends on what the sponsorship is. I think the lenders are looking now at whether they have a sponsor who's capable of taking the property through a rough time and restructuring it and turning it into something that works. You know, the lenders are looking at whether it's a project that's going to require a substantial infusion of equity. But the reality is that we're going to face a time where either the lenders are going to be taking back masses of properties and having to manage them and run them and figure out how they're going to recapitalize them, or whether the lenders and the borrowers are going to work together to stick in it for a while and see if things clear. But until liquidity clears, this is going to be a problem.
I mean, last year, about a year ago, April, I think it's exactly, and we weren't in that bad of a time. I had Larry Silverstein on my show, and I said to Larry, You know, I said, Larry, you've been around. Larry was 77, then he's 78 now. I said, Larry, how do you compare 1991 and 1990 to 2008? And his direct comment was, this is the worst credit cycle, credit environment I've seen in my career. He didn't say in 91, he said in my career. So my question to all of you is, how bad is it really out there for credit, and how bad do you think it can get? Because, you know, I was saying to you earlier that I went to this NYU READ event today, and I was positive compared to certain people speaking. How?
Let me respond to the first cycle that you asked Larry about. There were two major elements to it. First was the thrift debacle at the time. So there were lots of the OTS takeovers of the thrift. So there was a pullback in lending only because there were failures. And secondly, there was commercial real estate. Commercial real estate at that time was an absolute disaster. Okay. However, what was present at that, and the need for capital was necessary. But what's the difference? All it's kind of the same, except for the bank failures are occurring now. The big difference between that cycle and this cycle, as someone said earlier, is liquidity. So this is worse than it was in that earlier cycle in the late 80s, early 90s. With regard to credit, I can talk about the New York City area. It's gotten very, very tough to get a loan, whether it's a working capital loan, a real estate loan, a multifamily loan, and the standards that we apply as bankers universally are much, much stricter these days because of the risk you're undertaking, given the fact that we're in a very, very difficult recessionary period.
I think it really depends a little bit more on asset class, because what we're experiencing is on the multifamily and around the country, maybe New York City may be an exception, that lending window is very wide open and very robust. The other extreme might be retail, where the lenders have yet to sort out what the rollover risk is, as a lot of retailers are contemplating going out of business, or, as we've seen, going out of business or declaring bankruptcy. So a little bit depends on the asset class.
I also think if you burrow down into retail, what type of retail?
Right.
If it's garment, if it's electronics, a totally different evaluation.
And I think the other thing, the distinction between now and 91 is that 91, the economic or the basic economic problems weren't as systemic as they are now. You had the thrift problem, which was affecting the traditional banks, but Wall Street was there to step into the breach, and that's at the time that securitization started becoming popular, and securitization eventually supplanted traditional bank lending. Whereas now we're in a wide systemic problem where both the investment banking world, which doesn't really exist anymore as we know it, but the investment banking world, the traditional banking world, the insurance companies, all the traditional sources of financing are facing underlying problems.
Yeah, I remember 91 clearly because that's when I started my career arranging financing. So in many respects, there are a lot of similarities between today and 91. One of the big differences is where we came from to get to 91 versus where we came from to get to where we are today. We were at a peak, right? We were at a slow, kind of moving upward motion in 91. Securitization wasn't there yet. Securitization kind of popped in 94, 95. So, and securitization changed everything. And I've maintained that the reason why the real estate values have exploded the last 10 years has been 90% because of securitization. Absolutely. Right? Cheap debt. Tranching and cheap debt. So, what happened in 91? If you owned a shopping center and it was anchored by Walmart, you could get a loan from an insurance company, non-recourse. If that same shopping center were anchored by Kmart, it would be very difficult to get a non-recourse loan. It wasn't until CMBS came and said there's no difference between $1 from Walmart and $1 from Kmart that everything got financed, and cap rates moved from 11 on that Kmart asset all the way down to probably 6.5%. So recourse was the name of the game in 91. Recourse is the name of the game now. I'd say there's slightly less liquidity first quarter 09 than there was in 91. However, when the government programs kick in, we're probably going to quickly get to where 91 was. The only question for me is, how fast do we get from where we were in 91 and 92 to 95?
The question there is, which industries do we see as having, as you point out, the Wall Street quick rise in growth of an industry, And it may not be Wall Street this time around. And between Wall Street and law firms, they're the ones that grew this city over the last 10 or 15 years, just in terms of occupancy rate. We've got to determine and be creative as a country. Which are the next industries that are going to have explosive growth? Is it going to be energy? Is it going to be healthcare?
But I think, Marty, part of the situation is what we remember in Wall Street may not ever exist again.
It doesn't exist.
I agree with that.
You know, these
There's
are
there's no Wall Street.
there are no more investment bankers.
There's no securitization.
There's no more securitization. You know, I remember securitization. You know, at the beginning, you know, the rules were different.
No, but I see where Marty's going. Is that a lot of what drives real estate is jobs growth.
Right.
And we're probably not going to see that jobs growth on Wall Street. You will see it in education. You will see it in healthcare. You will see it not only in hospitals, but in assisted living facilities, nursing homes, those areas.
You know, you're right. But let's look at the income level of education, healthcare. These are lower income levels than you have. And these house prices, that these people can't earn it. You know, somebody who's a school teacher in New York City or in Long Island making $60,000 a year cannot afford a $700,000 home. And the prices are there. But part of the reason...
The market's going to adjust.
The market is going to adjust. I mean,
rents are going down, prices are going down, vacancies are up. The only thing up is cap rates.
To give you an example, an incredible statistic that someone told me yesterday is the average house price in Detroit. Now that's an extreme case.
Detroit.
No, but it's $18,000. That's the average home price in Detroit right now. So if that's not going to be every market in the United States. But you extrapolate as to what can happen in New York when industry contracts, is that home prices are going to go down so that
the market will adjust itself.
The market can absorb what's there.
You know, it's interesting. Yesterday I was in Harlem, and I remember 2 years ago, I always like when I would write or when I would do a show, I like to go to the neighborhoods and walk around. And I got off the subway on 125th in Lexington, and then I walked up to Lenox Avenue. And I remember I see all of these holes or these parking lots or these vacant lots where one was going to be a Macy's and one was going to be a hotel and one was going to be a new condo and what's happened, and one was going to be an office building on Park Avenue, and what's happened is there's nothing going on. There's no new office building.
Do you know why? When Wall Street fails, it's a trickle-down effect. The people who live in East Harlem and in Harlem worked for Lehman. They weren't high-priced people, but those people are out of work. The prices in Harlem are down as much as 40 to 50%. All construction has stopped.
Except,
it concerns me.
But still,
really from a social point of view.
But if you look at Harlem, if you look at the boroughs, if you look at Manhattan, it's still in an incredibly better shape than it was, let's say, in the 70s when I was growing up in the city, when you couldn't go to the Lower East Side. You couldn't go to Union Square. And we can't forget that the city, even though it's now experiencing a downturn in development and unemployment, is still a much healthier city than it was in the 70s, than it was in the late 80s, than it was in the early 90s.
And the investment we made back then is just going to inure to the benefit. Right. And just like we have trickled down, we will trickle up again. But we have to start first with getting employment up, as Steve said before. We have to start somewhere.
You have great optimism, don't you?
I am very optimistic.
I think you're right. I think it's going to be a longer time.
I think what separates us, meaning this country, from a lot of others, is we have creativity and optimism that a lot of other cultures simply don't have, and I'm very bullish. Will 2009 be a year to recalibrate and adjust? Yes. Yeah. We have to set up for 2010.
Think about how many hours you've sat in a room with your partners to figure out what your business plan is going to be for the next 12, 48 months, right? Smart people in a room. People are coming up with ideas.
So let's look at individual markets. You know, there are 4 different types of asset classes for real estate. And as Marty said before, and I think Dan also emphasized, the residential multifamily is the strongest. Banks like to lend on it. It's positive.
It's rent control.
It's rent control, stabilization. You know, it's over there. The second category would be office. New York City office market. How do you see the market today in New York City?
Well, it's soft. I'm not a rocket science that have to
tell you that. When do you see, when do you see a change? Do you see, is it going to be, certain buildings were bought at prices with expectations of $125 rent, or prices that aren't there? What do you see happening?
I think I see two things, and we talked about it before. One is, as we expand employment, you're going to start filling office spaces and expanding. The other thing is what Dan brought up before the show, when the architectural firm or the dentist or whatever you have sees that he can pay $25 a foot or $20 a foot that used to cost $50 a foot or $70, maybe that company is going to say, you know what, this is a great deal. I now have extra capital to expand my business. So it's going to take a while. I don't have a crystal ball. No. Maybe you do.
I don't have a crystal ball. I think the barometer is going to be here, Mike, is when you see unemployment begin to stabilize and begin to come down, then you'll see some recovery. And that hasn't happened. It looks like it's going to continue to rise nationally as well as locally.
Steve?
I see it's all related to jobs. I think the one advantage the office market has now is that there wasn't that much new office construction in the past 5-6 years. Most of the new construction was in the condominium area, and so fortunately there isn't an oversupply of good, high-quality office. I think what we'll see is a flight to quality as the great buildings, especially we haven't seen, I think, the impact of all the sublet space on the market yet. But I feel pretty good about office. I think I think you might find, as Marty said, that not only the dentists and the architectural firms, but a lot of service firms that had moved out to the secondary markets, be it Jersey City or Long Island City, might find an opportunity to move back into Manhattan.
But then we're going Manhattan-centric. That's good for Manhattan, but there are 5 boroughs over here.
Absolutely.
So the other boroughs may get hurt, and which they are getting hurt, because Brooklyn, where they projected a lot of office growth, is not moving to this growth level over here. What about retail? I mean, you've financed a lot of retail. Retail, I mean, Circuit City, a couple of others. When Steve Roth said this morning, when did you ever expect Neiman's, who never gave a discount, to have 28% lower sales in Christmas? I mean, New York City for hotels, for retail, is on sale right now. It's a great opportunity if you want to spend money and get a good deal. So how do you look at the retail marketplace?
You have to look at the underlying businesses in a retail asset and see the location, look at the demographics, look what's happening with sales in those particular assets. Retail's very localized, and in general, we all know that retail's getting pummeled, like the other asset classes today. But from a financing perspective, if you have credit or you have decent sales, you can get a retail project financed today.
Marty, both of you and Steve represent a lot of retailers, I assume. What's their position on signing new leases, or are they conservative? I mean, what do you see happening?
I think you're seeing a conservatism, and they're chopping costs and where they can, and the growth rate. Other than a couple that have announced significant growth plans, most of them are really shying away from that. I was going to comment on something Simon said. I read that there could be a silver lining to the mess we're in with unemployment, that there are a lot of creative entrepreneurs now that are jobless, that have a couple of dollars in the bank, that are very creative, and now we're going to put themselves to work by opening up a little store that they never had the opportunity to do that in the past because the rents were too expensive. So there may be a slow growth in
except that so much of the growth there is in the Web 2.0 world, where people can run their businesses in their pajamas sitting in front of their television.
That's a good point.
And it's not necessarily going to be heavy users of, leveraged companies that need a lot of real estate.
Marty brings out a very good point. Last week, 2 weeks ago, I did a show on restaurants, and I had Terrence Brenner, who said, for 5 years, I was looking at a variety of places to open up my artisanal pizza and a wine bar. I couldn't find a location because of the price. Now I have letters of intent for 3 different locations. The week after, I did a show, and I had the people from Godiva, who have 240 leases coming due in the next 16 months, and I had Benetton with all their stores, and they said, we're going to try to find lower rents. We're going to look for better opportunities because of this market. So retail, it's cyclical, in certain markets.
But we're also talking a lot about U.S. retail. I mean, the one thing that I've seen is there are some really creative, low-cost retail businesses in Europe that are using this market as an opportunity to come here for the first time. The Spanish retailers, some of the British retailers, I think, are
exchange is to kill them though. That those days are over.
Well, but they're starting to.
The dollar is, you know. Be careful with that. I don't see that at all. And another thing I want to point out to you in terms of retail, everybody is affected, whether it's garments, wine, electronics. It's across the board. And the thing that's happening with regard to retailers, setting aside the fact they're going to crush the landlords in terms of the rentals, is inventory management. So people are preserving capital, lowering the inventory. You start lowering inventory. This is just a microcosm here in New York City. I mean, throughout the country, when you start inventory managing down for capital reasons, because of risk reasons, then it's going to affect the overall economy. That's what I see.
What about plastics?
Hospitality. Next. New York City, as I said earlier.
I can answer that question if you want.
I was just kidding.
I can answer any question.
I was just kidding.
You know, I was saying.
I like that movie.
You know, I was saying before the show that New York City hotels are on sale. You said you stayed, or one of your clients stayed at the Hyatt for $125. $125, and you said that you had a client who stayed at the Hudson for $99.
My wife knows about it too, by the way.
Oh my God!
No,
so
a year ago, it was $400.
Yeah.
I mean, the hospitality market is truly hurting. So with like 35 seconds left, when do we see things recovering quickly? 2009, 2010? Steve?
I'm an armchair economist. I'm no more qualified than anyone, but I'd say the end of 2009.
Oh, you're positive.
Not starting to come back, not coming back.
Agreed.
Oh, the optimist over there. And you?
I think the government programs are critical, and they may not get them right the first time, they may not get them right the second time, but they'll have a big impact. So we just have to see how they filter their way through the system.
I hope the government programs, but you know, you can't create so many programs. You have to implement them, and they have to work.
They're already.
I'm going to be redundant. That's something I said earlier. Once I see unemployment stabilize, I'll answer that question.
Okay, so I'm very happy that a diverse group has been basically positive, even though I'm called Dr. Doom and Dr. Evil, talking about the state of the market. I'd like to thank Steve Rabinowitz, Marty Luskin, Simon Ziff, and Dan Healy. Next week, we have these real estate investment funds who have a lot of money sitting on the sidelines, and we're going to ask them what they're going to be doing with it. See you next week.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, KILROY Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, HELMSLEY-SPEAR, James D. KUHN Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, PALIN Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the MOINIAN Group.